It's 12 noon in the East, of course, and we are red across the board. NASDAQ is the biggest loser today. The S&P getting within a whisker of its 50-day moving average. That's something to keep an eye on. The 10-year yield at 4.31 at its peak today. That was the highest since early September. The 30-year is up. The dollar was down. Gold and silver at record highs, and the VIX at around 20. That pretty much sets the scene, I think. Joe, as Evercore says, this, what I just read to you, is sell America again.
You want to be troubled by something, I think it's the fact that yields are rising. That's the one condition today that I think is problematic. Yields are rising here in the U.S., as you cite, back to levels we haven't seen since early September, and then overseas in Japan. Why is that troubling? Because of the housing trade, which looked like it had a degree of revival over the last 3 days. Now, DHI, they did report, and you've seen a reversal in that stock intraday, so maybe the housing trade is still there, the opportunity still exists. But if you want to be troubled, it's by yields. The other side of it is, I've said all along, expect higher volatility in 26 and be tactical. And if you can't find something to be tactical on a day when the market is down greater than 1%, then you're not paying attention to the tailwinds, because as we're talking, you're seeing small caps making a run back towards unchanged once again. You have healthcare that's working, the XBI, biotech, which I'm in, is working, energy is working. So a lot of the themes of Q4, they're still there today, and you have some opportunities.
Okay. I thought there was an interesting exchange on Squawk Box this morning in Davos between the CEO of UBS and our own Joe Kernan about what all of this means for markets, whether more volatility is in fact in order, and how investors should react to it. Listen.
I don't see any path of normalization in the near future.
And when you say path of normalization,
path of normalization of lower volatility and more stability.
I'll take another year in 2026, like 2025 and 2024, volatility notwithstanding, though. I mean, there are tailwinds for the globe. Correct.
There are tailwinds. I mean, look, one could say 2025 was a great year, so, welcome for financial markets. But again, my point is that some of these topics are starting to weigh on investors' confidence.
Well, there could be a tipping point. It could be noise, like it was last year. I mean, Liberation Day was the best buying opportunity we had all year on April 4th.
Okay, so Liz, I think Joe has a point. Some will say they're exhausted by the erratic decision-making and the social media posts on policy, the threats, et cetera, which are causing volatility and more uncertainty. However, should you, which I think was Joe's point, should you tune out the noise and remember what felt like sell America last April was actually buy, a great buying opportunity. And just like then, the silliness of Liberation Day, this isn't going to get to the most extreme place. Earnings are going to be good. The economy is going to grow more than people think. The Fed's going to cut rates, and thus you should buy stocks. At any moment of extreme volatility, like if you want to characterize today as, buy stocks.
I do agree with that. At any moment of extreme volatility, I don't know that we're in an extreme moment right now that has lasted long enough to say that. And I also wouldn't say it paint it with a broad brush and say you just go buy risk assets in general. I think right now there still has been a big difference between some of the sectors that are still working and some of the industry groups that are still working. Tech is really the odd one out there. We've got tech not really participating in a broadening trade even inside the sector itself. So there's been a lot of pain in tech. I think, for example, you could buy something like software during this volatility. It's really taken it on the chin. And if the idea is adoption for the rest of 2026, software has to have a part in that AI adoption. Now, it still could go down further, but I think that software is a decent opportunity here. That all being said, the market is still sending signals that are pretty stable. We still have cyclicals leading the bunch. We still have investor appetite for things like industrials, materials, energy. So I don't think we can ignore that. And I still think the market is not entirely freaked out by this. Yes, we're having a down day, but I think we're downplaying it and trying to look at it rationally too. Let's just wait and see how this actually plays out. The last thing I'll say is I absolutely agree with Joe. The story of the day today is Treasury yields, and that will continue to be the story until this volatility ends.
So, Josh, you could easily say that Mr. Ermati of UBS and Mr. Kernan of CNBC are both right. That, yes, there may be a longer path to normalization of volatility in the near future, depending on what policy is done and where, and what threats happen and where and when, et cetera. And it should still be all viewed as noise, and that there are a lot of tailwinds behind this stock market, and those are the things that should be focused on more than anything else. How would you assess that?
Yeah, Scott, I think it's a good framing. They could both be right. And by the way, anybody can win any market argument by just changing the time frame. So, you could have a market sell off 20% and then not recover for 2 years, and then recover in year 3 and say, see, the smart thing to do is not panic. That doesn't mean right after it falls 20%, the person who says don't panic looks right. They're going to look like an idiot. So I think it's most helpful to just point out a couple of things. This is not truly a volatile environment. Like, no offense, I got 4 S&P sectors that are green today. I'd also point out, last year the S&P did almost 20% in total return. We had a full-blown 20% correction, pretty much bear market, even though it was short-lived. We also separately had a VIX spike to 50. And people forget, one of the things that happened last year, the Japanese stock market had like a 1987. We just decided not to talk about it the next day. So I don't really know what normalization is in the mind of, for example, someone from UBS. I don't really know what it means to Joe Kernan. I would just tell you, this is normal. We have these freakouts. We have these panics. If you want to take your portfolio and act like it's 1937 and we're about to invade Denmark, we're going to fight a war against Legoland, you're very welcome to do that. We in the wealth management community don't behave that way. No, so gold is great. It acts really well. It acts really well. Energy stocks are up today. I've been talking about it, Joe, too, for 3 weeks now. Ad nauseum. Oil could be this year's gold. There are things that are offsetting whatever's going on with your software stocks, and that's what it means to manage a portfolio and be an adult.
But Belsky, I think to expand on Kernan's point, if you would have gotten all worked up on the DeepSeek day, where tech falls out of bed, a lot of people on the desk and otherwise are saying, hey, this could mean this, what if this happens? That moment was a buy. If on Liberation Day you got all upset, worked up by holding up those big placards with the big numbers and said, man, what if this could? That proved to be a great buying opportunity, as most of the dips in this market over the last year have proved to be. The broader point being, a lot of it ends up being noise. And the environment for buying stocks, I hear from most people, hard to find bears around, continues to be great for all the reasons that I said. Earnings, interest rates are going to come down, deregulation, more deals. I could go on. What do you think?
There's 2 different buckets that we're talking about. Number one, the new norm, unfortunately, is binary trading. Buy, sell, green, red, and it's been going on since COVID for all intents and purposes. And I can even make a case, Scott, that it's been going on since 2009 in terms of this buying, selling. That's what we're doing. From a longer-term perspective, if you take a look at the tailwinds versus the headwinds, this is a headwind today. This is an absolute headwind with this behavior and the news flow and things like that. But the tailwinds, you did an amazing job talking about what the tailwinds are. We are transitioning from a multiple-driven market to an earnings-driven market. In earnings-driven markets, historically, it's still positive, but the returns are less. With respect to normalization and our mutual friend Joe Kernan, oh my gosh, I would love to have a normal market. We have not had a normal market for all intents and purposes since 1995-96, where it was fundamentally driven, where you had this broader display. I do believe that it's excessively positive, as Joe talked about, with respect to small caps doing well. I think we're going to broaden out. The market's telling you that. So headwind, short-term, longer-term tailwinds are still very much in play.